And now for something completely different.
It's a rich man's Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to Omicron Tuesday, I guess. Actually, it's technically speaking Tuesday. The article on our website this morning is just kind of a pickup on what we've been talking about here lately, that, a correction was likely in the first couple of weeks of December. And, hey, it started, right? And we've been talking about this for the last 2 weeks as the markets were going up and kind of consolidating that run. We said that once we got past Thanksgiving, there was a risk because of mutual fund distributions or whatever the reasons are that we'll have a correction. Then normally that sets up the kind of the end of the year rebalancing for portfolios, which is typically termed as the Santa Claus rally. So, well, yesterday, of course, we had a nice rally. So Friday, big sell-off on the markets. We talked about that yesterday. Nice rally yesterday, Cyber Monday rally. The thing about that rally yesterday is that, it was on, fairly light volume, much lower volume than what we saw during the sell-off on half a day on Friday. So, that's one thing to really consider. The markets were only open half a day on Friday, and you had more volume on the selling side than you had on a full day of trading yesterday on the rally. So again, while there was this rally yesterday, again, not a lot of commitment to it as always, but that's been the case here for a while. Volatility really remains, kind of suppressed over longer term trends. Had a nice spike here because of that sell-off on Friday, but that's starting to quickly reverse. One thing to note here is that, and one thing we covered in today's daily commentary, which is on the website, the market did rally yesterday, but failed to get above the 20-day moving average. It ran right into it, bounced off of that. So that overhead resistance, which has been previous support here for the markets during this rally, is now acting as resistance this morning. Markets are looking to turn down again. So futures on the Dow down about 358 points on the Dow. S&P futures are down about 40 points this morning. So, that's, we're kind of still in that process here of working through that correctional period. So there's some good news here though. We're in that correction process. We've talked about this for the last couple of weeks. We talked about raising some equity, some cash levels, trimming back profits and just kind of rebalancing portfolio risk. So that's helping kind of navigate this kind of period here that we're having during this correctional process. But our money flow indicator is now very, very oversold here, and it's starting to bottom. So that's actually kind of the first good signal. It doesn't mean that we're out of the correction process yet. It doesn't mean that we need to go buy a bunch of equity right today, but it is starting to flatten out, and that is the initial kind of sign that we're starting to approach the nadir of this correctional process. Probably have a few more days of this volatility kind of back and forth. Again, we're still moving into mutual fund distribution period, so there is going to be some additional selling pressure on the markets. And as we talked about before, the problem is that between where prices are currently and kind of the real next level of support, which is down here at the 50-day moving average, there's a gap of buyers. And this is the one problem that we've had with the market really all year long, is that there's fewer people that are willing to buy and sell at current prices. And so sellers are having to come up to meet buyers, and that's what's driving prices higher. The problem is that when the sellers want to actually sell in volume, there's no buyers there to meet them. And that's why we have these sharp down days of down, we're down 1.5%, 2% in a day. And we have these very sharp corrections in the market. That's because of the gap between where buyers and sellers are. And that's that liquidity problem that continues to kind of show up in the markets repeatedly over the course of this year. And this is why we see these big downdrafts in the markets, but then we see rallies on a lot lighter volume, because the buyers that want to buy are having to drag sellers up, and there's not that many sellers in the market right now because nobody wants to sell. Fear of missing out, right? I've got to be in. I don't want to miss out on the rally. And so that's why we continue to see this really kind of thinly traded market, this lack of liquidity, and it leads to more volatility and price movements. And we've seen that all year long, and I think it's going to get worse next year if you take a look at the volatility of the VIX. So the VIX is what measures volatility in the market. It's a measure of market volatility, often referred to as the fear-greed index type thing. Well, the volatility of the volatility is now starting to rise as well. Now, that is one thing that we haven't seen here really over the last few years because there's been so much complacency in the markets. And now as we move into 2022, we're going to have a reduction in global liquidity flows. We had over $1 trillion of liquidity flow into the markets this year. That's going to start to reduce next year. And if the Federal Reserve begins to hike interest rates and begin to taper their balance sheet, that's also going to potentially begin to weigh into that liquidity process as well. So a rising volatility moving into next year suggests that we could see a lot more movement in markets, both up and down. But as opposed to this year, which has been a fairly quiet year, we could see a lot more 5 or 10% corrections as we get into 2022. Just something to think about. But as we've talked about here, of course, the big risk to the markets near term and really kind of going into next year is the Fed beginning to taper their balance sheet. This is, that liquidity that's been coming in, $120 billion a month, zero interest rates. That's been a big support for the financial markets. In fact, if you take a look at the excuses that are used by the bullish purveyors of Wall Street, it is, low interest rates justify high valuations, $120 billion a month, don't fight the Fed. All of these excuses, of course, are hinged upon the Fed continuing these monetary transactions. The concern here as of late is that the Fed's been talking about tapering their balance sheet, beginning to talk about hiking interest rates because of inflationary pressures. Well, it didn't take much, but yesterday, Jerome Powell, in prepared remarks for the CARES Act testimony, said that, the Omicron variant is a potential threat to employment and economic growth. And, that is the excuse that he needed. So there was that first shot across the bow by the Federal Reserve to use the Omicron variant as a excuse for beginning to slow the taper process and potentially delay rate hikes. And that was another reason that markets rallied strongly yesterday. This morning, though, of course, is a bit of weakness as the markets are still trying to grapple with just how serious this is. Is it going to lead to more supply chain shutdowns? Is it going to create more economic disruption? What's going to happen? It's the unknown that Wall Street is trying to price in right now. So again, this volatility in the market, and of course, as we've talked about, the potential correction in the markets in the first couple of weeks of December, that is historically typical because of mutual fund distributions. But what really needs to occur is you need a catalyst, and Omicron variant is providing that catalyst here over the last couple of days for this correctional process. This was something that was going to happen anyway. It just needed a reason. And so the headline reason is the Omicron variant. The markets will price this in over the next 2 weeks, and that's going to set the markets up for that traditional year-end Santa Claus rally once we get that behind us. Now, having said that, of course, once we get into 2022, all bets are off. It's a whole new ball game after the middle of January. So we'll talk about some of those risks as we get a little bit closer. But when we come back from the break, we do have a lot of other things to get into this morning. So stick around. Be sure and get by the website, realinvestmentadvice.com. Our Technically Speaking article is up this morning talking about the market correction, the Santa Claus rally, and how to trade for that. That's on the website now, realinvestmentadvice.com. That's realinvestmentadvice.com. And make sure you're subscribed to our daily market commentary. While you're at the website, click the banner, subscribe to our daily market commentary. We deliver it every morning before the market bell. Stuff you need to know about the markets and your money. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual lunch and learn on long-term care. December 9th at noon. RealInvestmentAdvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Lance Roberts. Just waiting on you to get your act together over there. So,
pushing lots of buttons over here.
I can always tell when the camera's not in the right place. You haven't done your job yet.
We'll go back and look at the video. It was pointed at you.
No, I'm watching it. It was over there. Anyway, good morning. Welcome back to the show, of course. Brent has all these new toys that he's still trying to figure out. So, Renault, the automobile maker.
Yes.
Yes. They make
the French ones.
The French ones. They make the world's ugliest cars.
Yes.
Yes. And now they've made the world's ugliest flying car. So, so
it's a bird. It's a plane. It's a Renault.
Exactly. I'm just going to buy this one. Let's put a shoebox on top of a drone. That's what it looks like. So
it's a flying car that looks like it's already crashed.
Right. Exactly. Yeah, this is going to be some of the and again, people can't drive on the freeway already.
Oh, yeah.
Right. Can we imagine when we put them all in the air to fly? Mm-hmm. I mean, this is going to be like get a box of popcorn, sit back and watch. And how many rednecks in Louisiana are going to try to shoot them down? That's going to be the big thing, right?
Or you mount one on your flying car, and now you've got dogfights in traffic.
Exactly. Well, that's not so far from the truth.
A whole nother level of road rage.
You beat me to the punch. Yeah. Anyway. As I was saying here, just for the break, yesterday, Jerome Powell had prepared remarks for the CARES Act hearing, and of course, one of the things that everybody's looking for right now is for him to become a lot more dovish potentially, and that's the expectation, right? That the Fed really doesn't want to hike rates. And they really don't want to taper their balance sheet because they realize that if they remove that support from the markets, that it's going to become problematic for them to do their other work. Again, we have to go back to Ben Bernanke in 2010 when he discussed the fact that doing QE was needed to lift asset prices. And by lifting asset prices, that would create better consumer confidence and that would help economic growth. And that worked for a little while. We've talked about, however, this idea of efficacy of these monetary policies. Every time you do these monetary policies, it requires more and more to get the same relative effect. And there's two reasons for that. The first reason is if you go back to 2010 and take a look at the amount of equity assets that were owned by the top 10% of households, it was much lower than it is today. I should say, let me rephrase that, that's backwards. It was much higher than it is today. Today, 90% of the stock market is owned by the top 10% of income earners. And this has been a very sharp advance in that percentage of ownership just over the last couple of years, in particular because of the spike in the balance sheet as well. And that certainly boosted the values of invested assets. Well, the problem with most Americans is they don't really have much money in the stock market. In fact, the bottom 50% of Americans have virtually no money in financial equities outside of maybe their 401k plan at work, if they have one. Again, when you take a look at the number of participants in 401k plans, it's about 25% of Americans that actually participate in their 401k plan. Only about half of Americans actually have access to a 401k plan. And of that half that do, only about half of those actually contribute. So for the bottom 50%, they have very little equity ownership of the financial markets. The next 40% have a little bit of equity ownership, about 9% of the market, and the rest of it's owned by the top 10% of income earners. So the problem with QE, of course, is that as you continue to inflate asset prices, more and more of that money shifts to the top 10% of income earners who don't need the money. They're fine. Take a look at savings, right? We hear a lot of talk about savings rates. We have a massive savings rates right now because of all this liquidity, checks to households. All these Americans are flush with savings. No, they're not. Savings, just like the financial markets, are primarily contained by those in the top 10% of income earners. Why? Because they're already living to their normality, I should say. If I give somebody that's, let me rephrase that. If you're making $400,000 or $500,000 a year, $300,000 a year, whatever it is, probably during the pandemic, your lifestyle didn't change too much. Maybe you didn't travel because of the pandemic. Maybe you stayed shut down a little bit. Maybe you didn't go out to eat as much. But for the most part, you're already consuming at whatever rate you're going to consume at, right? You already own the cars that you're going to buy, and you already own, all the gadgets that you want to own. There wasn't a whole lot on your wish list that was sitting out there that you missed out on because you either had enough, even if you lost your job, you had enough in savings to cover the gap until you got reemployed. So the accrual in savings was really a function of those in the top tiers of income earners that postponed a trip or didn't go out to eat as much or didn't do some things that they wanted to do because simply they weren't able to do it because of the virus and the shutdowns, right? So that money accrued on their balance sheet. But really, as far as the other things about life, they were still buying their food and doing what they wanted to do. So when the lockdowns have reversed, yes, they went out and took that trip that they had postponed. And yes, they went out to start eating again on a normal basis. And we've seen that in the economy, but that did draw down that excess savings that they had built up over the last year because of just lack of ability to consume, not lack of cash. And so we still see these very large savings balances. And everybody goes, well, there's all this money on the sidelines. No, there's not. It's just in the top 10% of income earners, and there's nothing for them to buy at the moment. They're not going to take 4 trips this year because they missed out on 2 trips last year. They're just going to go back to their normal consumption habits. So that excess cash is just going to accrue there for a while. But for those in the bottom 80% of the economy, they have no savings. They're already back. Take a look at what's going on with credit card debt as a good example. You're already starting to see a big surge in credit card debt as individuals have to go turn to debt to try to make ends meet because of inflation. They're not buying more stuff. They're buying the same amount of stuff at higher prices, and they don't have the cash to cover it. So you're seeing that turn back to spending on credit. So, this is the problem. And what the trap the Fed has got themselves into, of course, is if they now let if the financial markets correct, then they suffer that loss of confidence across the markets and the economy, because the economy, the stock market's correcting, and people assume that if the stock market's falling, something bad's happening in the economy. So it affects everybody when the stock market corrects. The problem is that the people that are most affected are the people that have the money invested in the markets. That's the top 10%. And of course, a lot of those are the high net worth investors that are clients of Wall Street. Wall Street and the major banks are, of course, have a lot of influence on the Fed. So not surprisingly, Jerome Powell, who's been talking about the need to start hiking rates and tapering the balance sheet because of inflationary pressures, took the Omicron variant as the first excuse he could find to lay out the case for maybe having to slow his roll a bit. And that's what he said yesterday in his comments, his prepared remarks. Here's the actual prepared remarks. The recent rise in COVID-19 cases, speaking, and the emergence of the Omicron variant pose downside risk to employment and economic activity and increased uncertainty for inflation. Greater concerns about the virus could reduce people's willingness to work in person, which would slow progress in the labor market and intensify supply chain disruptions. So there it is. That's code for, hey, we're watching this, and if it begins to pick up steam, we're going to, have to slow tapering and potentially delay hiking rates, despite the fact that we've got inflationary pressures. And so this kind of really goes back to that question, is inflation transient or not? And that's the big battle. Yesterday, President Biden had CEOs of Walmart, Target, Kroger's, Food Line, others, up at the White House to talk about supply chains and talk about inventory levels and those type of things. Walmart CEO said, hey, you know what? Well, we've got 10% more inventory this year than we had last year. We're in pretty good shape going into the holidays. Supply chains seem to be easing up already. According to these CEOs, they said that they're already starting to see some improvement in the supply chains, the movement of product off of ports. So if that's the case, if the supply chain is finally starting to break loose here, then inflationary pressures should start to come down. And this idea of transient inflation may work in the Fed's favor. But there's other things in the economy that suggest that maybe inflation isn't so transient. High oil prices feeding through to higher energy costs, of course, higher heating costs, natural gas prices. A lot of hopes right now for a warm winter, maybe bring down some of the natural gas prices. We'll see. But while there's hope that the supply chain problem is improving and inflationary pressures are declining, the problem for the Fed is still this very fine line between what they're doing in terms of monetary policy and the impact long-term to the financial markets and the economy. Be right back after the break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care. December 9th at noon. realinvestmentadvice.com.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I went to see the doctor. Really great guy, but he's an older guy, kind of like Coach Murphy that you grew up with in high school. And it never cost me more than $25 to go see him because his solution is pretty much the same every time. Rub some dirt on it and walk it off. And I said, well, don't you have something you maybe give me for the pain? He hands me a thing of Tic Tacs. He says, take one a day and pretend it doesn't hurt. What's your problem?
The Real Investment Show podcast. Same show, your schedule.
And it works just fine.
At realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, in the last segment, talked a little bit about Jerome Powell now already starting to make his dovish twist to being a little bit more friendly to the financial markets. And of course, not surprising here, the big concern moving into 2022 was that tapering the balance sheet and a hike in interest rates. Of course, that was expected to start in June of next year. Now, again, right now, the markets are still pricing in 2 rate hikes for next year and a reduction in the balance sheet really still on the table at the moment. So that hasn't changed. But my point in the last segment is that these comments in front of the CARES Act committee is really kind of that first shot across the bow that, hey, maybe we'll have to slow down here a bit because of, potential impacts to the economy from the virus. Now, the question that I think we have to really ask ourselves is really twofold. First of all, we continue all these monetary support actions, which are certainly inflating asset prices because, again, the theory is that if I have $120 billion a month in QE coming into the markets and zero interest rates, then I can afford to overpay for assets. And this has created a lot of speculative fervor in the markets, not just by retail investors, right? This has happened. We've seen Wall Street taking full advantage of this. Record IPO issuance, SPAC issuance, record leveraged loans being put out into the markets right now. So we're seeing, the risk appetite is very high. Mergers and acquisitions are kind of off the hook right now. It's literally money laying in gutters. If you want to sell your business right now, this is the time to do it. People are paying stupidly high valuations for businesses currently. So not surprising. That's what happens when you have a lot of money in the markets. It's got to go somewhere. Money's got to get put to work. If a hedge fund sitting on, or a private equity firm or whoever is sitting on millions of cash, they're not making any money, and they've got to make money in returns for their clients. And so the problem with too much money chasing too few deals is that we start investing money into really kind of crappy companies, just trying to get the money deployed. And we're seeing this in a lot of the IPOs that are coming out. We have a lot of IPOs hitting the market. In fact, a record number of them coming to markets that have no income. Lots of hope they'll someday generate some income, but they have no income. We saw a company just IPO recently with over $1 billion worth of market cap that has $35,000 a year in revenue. Kind of tells you what the problem is. Lots of hope, right? We saw this back in 1999, by the way, same thing. But this is the distortion in the financial markets that's caused by this massive financial liquidity push. And of course, trying to remove that is problematic. Because again, as far as the Federal Reserve is concerned, if they begin to reduce this monetary liquidity, if they begin to hike interest rates, which is effectively tightening monetary policy and slowing the economy, which is what higher interest rates would do, that makes it problematic for them when the market begins to reverse course to price in less liquidity and higher interest rates, right? That's just a function of how the markets are going to work. So not surprisingly, the Federal Reserve is in this trap, and they realize they're in the trap that for a decade, they had zero interest rates and no inflation. Economic growth kind of limped along at 2%, which was fine, but they had no inflation to worry about. Now, all of a sudden, they've got inflation to deal with, and that's different because, of course, one of their primary mandates is full employment, which effectively, by all terms and manners, we're at full employment in the economy. You've got record low jobless claims right now. So for all effective purposes, we're at full employment, and you've got inflation running well above the Fed's goal of 2%. So from a monetary policy standpoint, they should be hiking interest rates. But they're looking for an excuse not to, and this Omicron variant is the excuse not to. Look, and we've got a long line of the Greek alphabet left to go in terms of variants. So plenty of excuses out there for one variant after the next. If you go get a flu shot, and this is the funny thing about vaccines. If you go get a flu shot, it covers about 5 variants of the flu. There's like 150 or something odd variants of the flu, seasonal flu. You go get the flu shot, you're getting the 5, kind of primary flu variants that are out there, and that kind of works through some of the rest of them. But it's still not surprising if you still come to, even after you get the flu shot, it's not surprising you come down with a flu, right? It's just, you're kind of taking a crapshoot inside of just maybe hoping you get the right variant of the flu that the vaccine works for. But this is the problem with this coronavirus variant is that, and we talked about this when, back in 2020, when this whole thing first hit, we said, look, we'll eventually get a vaccine, but that vaccine will be for 1 or 2 versions of the variant, but then we're going to get multiple variants of this COVID this COVID virus that is going to be problematic, and we're going to continue to fight this thing. And because this is what happens with viruses, once you start attacking the virus back, it mutates to fend off what you're attacking with. That's how a virus works. So we're going to go all through the Greek alphabet eventually with variants of COVID-19. So we've got a choice. And the Fed's got a choice. We can keep using these as an excuse not to slow monetary policy and try to normalize equity markets. Or we keep doing this and we keep inflating a larger and larger financial bubble. And eventually the bubble's going to pop. It's just a function of when. But whenever you have the type of speculative behavior that you have in the markets, it eventually is going to run out of money. And that's the whole thing, right? It's the whole thing with government too. There's an old saying about government. Eventually you run out of other people's money. You can fund all these things on debt, but eventually somebody's got to pay for them. And it's the people that are earning some income that are trying to pay off the interest on the debt. Yeah, you can give away free college and free all this other stuff. That's fine and dandy. No problem with that at all until you run out of other people's money. It's the same thing in the financial markets. Eventually everybody that's going to buy will have bought. And eventually the selling comes for one reason or the other. And you never know what the catalyst is that causes the selling. But eventually you trigger that point to where the selling begins in earnest. And the buyers are there. Of course, there's always buyers in the market. It's just a question of where they are. And if we go back to 2020, you kind of really got a good glimpse of that when you saw that 35% decline in a month. That was very unusual to run that big of a decline in a single month. And that was because the gap between the people wanting to sell and the people willing to buy was very large, and it's gotten worse since then because of what the Fed's done. So the Fed's really in this very tough position in terms of navigating markets and trying to maintain some fiscal stability and monetary stability in the markets. And then we talked about this just yesterday in our blog post, that the Fed will be the cause of the next crisis. And the reason is that their whole idea and structure of monetary policy is to maintain stability in the markets. And this is why you saw Jerome Powell pivot so quickly yesterday and start to look for this excuse of the Omicron variant to slow his roll in terms of tightening monetary policy, is because he needs to maintain stability in the financial markets. So all that means is, of course, is that nobody's willing to push the big red button at this point, right? But that's the problem with stability. The more stability you have and the longer that you have stability, the risk of instability increases. And the problem with that is that eventually when stability gives way, the period of instability is very fast and very quick and very large. So, the bear markets of the past, where we saw bear markets last, 12, 18, 24 months, those are going to get more and more compressed as we go forward. The next real bear market that we're going to have may last 3 months, may last 4 months, may last 6 months. Because the correction will be so quick, because you've built up this compression of prices in the markets. And so when that spring explodes, it's going to move very quickly in the opposite direction. But this is the problem with stability, right? And we've talked about this. Stability ultimately leads to instability. It's a question of when and what causes it. And again, right now, what the Fed's hoping for is that they can keep stability in the markets. And again, everybody has this fear of missing out. I can't miss out on the markets. The markets are going up. I put money in. I make money. It's a guaranteed ATM. That's the psychology. And, retail traders think they have it all figured out, right? They just buy the most shorted stocks in the markets, and they force a short squeeze to make markets go higher. That's fine, but eventually Wall Street figures that game out. And again, don't forget, there's very little difference between Wall Street and a casino. Wall Street is the house in this particular casino. Wall Street always wins this game at some point or the other. It's just a function of when they win it. And this is always the interesting thing about gamblers when they go to Vegas. They think that they're going to beat the house long term. You may win a few hands. You may win quite a few hands. But you better know when to leave the table, because eventually, if you stay at the table too long, the house will win. Every single time. All right, quick break. We'll be back talking about markets. Your money. Don't go away. More of the Real Investment Show coming right up.
Get Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Retirement's not what it used to be, and long-term care could enhance your golden years. The question is not whether you can afford it, but whether you can afford not to have it. Our next virtual Lunch and Learn will cover the management of long-term care expenses that could make or break your retirement. Join Jonathan Penn and Chris Liebum for the basics of long-term care. Register at realinvestmentadvice.com for our virtual Lunch and Learn on long-term care, December 9th at noon. realinvestmentadvice.com.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, simply online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Article this morning, the rave reviews of Tesla's Model Y keep coming in. Call the vehicle critically flawed. CNET has joined Consumer Reports in publicly trashing Tesla in a new review of the company's Model Y. Reviewer Tim Stevens, who's likely to become the next target for Elon Musk on social media, penned a scathing review last week. He reviewed a Model Y about 3 months after CNET purchased one. The car got a 6.7 out of 10 in a review that Stevens admits up front will not be good. You should absolutely not buy one. That was the starting line of the review. He goes through the entire thing. He says, he says, as he goes through, kind of this whole review process, he took exception with the car's visual panel, stating that it kind of looking at autopilot status and navigation prompts means, having to gaze well downward to the bottom of the display rather than keeping your eye on the roads. This, as he goes through the entire thing, this is going to be one of the things. Here's the thing about this. This is going to be one of the interesting dynamics as we get into next year. When you start taking a look at the number of models that are coming into the markets, right, from different manufacturers, et cetera, it's going to be a competition to who can create, the best car, who can create, the best environment, all these type of things for electric vehicles. So, this is the beginning of that change. And eventually, look, the reality is that, car makers are very, very good at changing consumer habits. And, if you kind of go back in time and look at some of the vehicles that you see on the road today, 5, 6, 10 years ago when these cars were first introduced, some of them didn't sell very well at all and required a lot of incentives for them to get sold and get on the road. But eventually, the automakers changed the taste and demand of consumers to where these cars became more adopted for whatever reasons. And so automakers are very good at that. And they understand consumer behavior, they understand consumer psychology very well, and they understand how to eventually change those styles and demands that consumers want into what automakers want them to consume. So if there's a higher margin product or whatever it is, they can eventually tailor that to get people to buy that car. And this is not new. I mean, everybody knows this, right? So, so over the next decade, right, we're going to see more and more electric vehicles offered by more and more companies. You're going to see, different benefits and features and ranges and all this other type of stuff. And it's just going to be, kind of this changing of consumer demand being driven by automakers as much as it's going to be driven by, demands for electric vehicles. It's going to be a function of supply and demand. And that's okay. We'll eventually see this play out. But what's going to be interesting to watch is going to see who the players are going to actually become. There's a lot of new car makers coming to markets right now. We've seen this before in history, right? We saw DeLorean, we saw the Studebakers, we saw all these, competitive automakers come to markets, and some of them did okay, some of them didn't. DeLorean had its own issues. His car kept going back in time for some reason, I'm not sure. But anyway, we'll see who survives. And some of these companies that people are investing in today, whether it's, and I don't know who the players are going to be, but whether it's Rivian or whether it's, Lee or NIO or even Tesla, right? Some of these automakers will not be around in the future because they'll lose out to the competitive advantage for whatever it is. And so, it's one, and here's the point I want to make, is that it's okay to invest in these companies. Just realize that some of these companies aren't going to make it. And so fundamentals do ultimately matter to these companies. And, when you go back and look, does the company have the ability, and this is one of the kind of the flaws of the analysis of Tesla, which, again, I don't have any problem with Tesla at all. But from an investment standpoint, the idea is that, this company is worth so much more. In fact, this one company is worth more than every other automaker combined because it's not really an automaker, it's a technology company. It's not really true. They make autos. And eventually somebody's going to come out with a different type of battery. And somebody else is going to dominate the battery market. Somebody else is going to dominate some other phase of the market. At the end of the day, Tesla makes autos. That's what they do. And so they're going to ultimately wind up competing in that automobile market. And this is the same thing for all makers, whether it's Ford or GM or Chrysler or Porsche or Ferrari or whoever it is, right? The world's ugliest car company, Renault, right? I mean, all these companies compete in the same environment. And so ultimately, at the end of the day, those fundamentals will matter. So my whole point about this, and this really kind of comes back to, the speculative nature of the markets and the things that we have going on right now. There's a lot of things that are happening in the financial markets that are very clear that we're in a financial bubble. And so it's important to always come back to the fundamental basis of investing because that's what protects you. Look, eventually this cycle will turn, and the difference between those that lose 50 to 80% of their money versus 10 to 20% of their money will be the differential between fundamentals, who has them and who doesn't. For those people that are investing heavily into companies with no fundamentals, they're going to lose 50 to 80% of their money, if not more. During 1999 and 2000, 2001 and 2, and through 2007, 2008, I saw people lose 90% of their money or more because every company they owned went bankrupt. So fundamentals matter, and fundamentals may not seem to matter right now because of the speculative nature of the market that we're in, but fundamentals matter, and they matter when it matters most, and that's during the decline. Because money will seek out fundamentally stronger companies during a decline. You're still going to lose money, okay? if we get into a rip-roaring bear market of, 20, 30, 40%, whatever it is, and eventually that'll happen for whatever reason, you better have some fundamentally strong companies that actually generate revenue, have a balance sheet, have cash flows, those type of things, because those are the companies that'll survive. A lot of these other companies won't. And so my whole point here is just to be careful. It's always important to know what you own rather than just buying things because they're going up in price. And we're seeing a lot of that action in the markets right now. People just buying stuff in the market simply because it's going up. That's the only reason. Wow, I can't. This stock was up 80% yesterday. I need to buy more of it. And when I scan for stocks, I see a lot of companies that are moving up sharply simply because they're moving up sharply. There's no fundamental value to it. There's no real business plan to it, etc. And those things tend to revert to their mean just as fast as they went up. And one of the things that we're seeing now, of course, is the most shorted stocks in the index that are moving up the most. And again, as what retail traders have kind of figured out is that if they can go attack these stocks that have big short positions on them, they can start pushing, because of low liquidity in the markets, they can start pushing these stocks higher, and then that forces the people that are short the stock to cover. They've got to buy it, which forces the price up even more, right? So they figured out that game near term. And, if you take a look at the most shorted stocks in the markets and the ones that have the heaviest call options on them by a large degree, Tesla is number one in both categories. So it's a bit of a risky game, but it's not. But again, it's not just Tesla. Let's take a look at some of the most heavily shorted stocks in the index right now. Here's the top 10: Tesla, S&P Global, Moderna. Of course, it was up like 10% yesterday. Bank of America, and that's why, right? These big moves, right? A stock moving 10% in a day. Something else is going on other than just good news. Moderna, Bank of America, Home Depot, Intel, Comcast, International Business Machines, IBM, Adobe, up big yesterday as well, PayPal Holdings. And when you dig through this list, you see a lot of the usual suspects, right? Pfizer, another good example. Pfizer up big yesterday as well. News headline was, of course, the Omicron variant. But you take a look at how much market cap that the company added yesterday relative to what the benefit of whatever additional vaccine they might sell at this point because of the Omicron variant. The company went up more in valuation than they can possibly earn from selling the vaccine, right? So again, it's that mismatch of what's happening in the markets. But when we go through there, you're seeing companies that are potentially extremely risky going up a lot. And so again, just the point here is to understand that we have this speculative nature in the markets. That's okay, right? This has been driven by a lot of liquidity, low interest rates. Hey, I get it. It's all good. Just realize that things will eventually change. Global flows that have been over $1 trillion this year will slow down probably next year. We're already starting to see those kind of peak. There's too much money chasing too few assets. That will change. So just as you review your portfolio and look at the risks that you're taking, just make sure that ask yourself this one question, right? In the downturn, which of these companies will survive and which won't? That's one sure way to help make sure that you survive the next downturn when it occurs. That's the show for today. RealInvestmentAdvice.com. See you back here tomorrow.
It's a rich man's world.